navigate over to the Power Options suite of tools. Of course, what you're looking at here is the basic structure of a 14-day free trial to Power Options. Those of you that are just getting started, I encourage you to take the 4 steps here that are listed to access the free quick start guide. You can review the flash tutorials to help you get more familiar with the tools on the site. Step number 3, of course, we do host a lot of live webinars and archive many of our webinars you can access at any time. And those of you that are currently on a trial or subscribe to Power Options, you can schedule a free coaching session at any time as well. Okay, so we're going to use these tools, of course, to help illustrate our questions that come in. First question comes in from Martin. It's a follow-up from last week. Martin says, did you have a chance to look at the back ratio spread we talked about last week? If a stock or index is going down, sell a put with enough credit to buy 2 lower strike puts with only 1 strike between the strike prices. Well, I've been researching that most of the week in my spare time when I'm not doing other projects, Martin, because I haven't scheduled it yet. I haven't posted it yet. But next Wednesday at 12 noon Eastern Time, we're going to host a presentation, of course, on the stock or portfolio insurance that we talked about, revisiting those old blog articles and revisiting those old webinars we had looking at different ways to manage a portfolio in the situation of a market downturn. So what we were talking about last week, let's just take, let's try it. Let's try SPY. And what Martin was referring to last week is taking maybe a couple weeks out or a 1 month out position, using a ratio spread on a stock in particular or an index to help hedge a portfolio in the case of a large market downturn. And his idea was using a ratio back spread. And let me just go out 28 days to October 6th. And what I'd want to do is sell maybe an at or slightly in the money put and buy a lower strike put twice as many. That's the ratio spread, by twice as many, but still receive a credit on the position. Now here we have to go pretty far apart. Let's just take selling the 2, we're expecting a downturn, so let's go ahead and sell the 248 actually. Let's put it at about 353. And then I'm going to go ahead and buy 5 points away 2 of the 243 puts. I'm going to put in a, this isn't really a good net credit, of course, we talked about that. Let me actually take that out. Instead of 5, yeah, let's just put in some numbers, all right? So in this particular spread, I'm going to sell 1 slightly in the money 248 put, and we're going to call it 355. And then we're going to buy 2 lower strike puts, 243 strike, and I'm going to put this at 175. So the net credit is not that great. This is what we talked about last week with using SPY or SPX. I can get a net credit by going a far strike difference. But see, in this case, the break between, here's where it gets tricky. This is why we found out last week that SPX won't really work in these scenarios. So what you're seeing here is the dip, but the profit and loss chart would start to go back up here to where if there was a large enough decline, you'd have infinite upside. Now, why does Martin mention that usually only 1 strike price works, a 1 strike price difference, if we can get a net credit? Well, because if you're wrong, you can still receive a credit. But now that I've got a 5-point strike difference, I've got all this chance for loss from the 248 to the 243 strike. So this really only works when you're 1 strike apart or less and can still receive a credit. And SPY, SPX, as we saw last week, was not a good example. So what were some of the other things we looked at in the case of a market downturn? Well, there might be some 2 times or 3 times ETFs. Gold, for example, GLD, things of that nature, the 2 times GLD that might work. Other securities that might work. But not every security is going to give you what you want as far as these ratios go. And that's the tricky part. We use SPY because we know that the S&P 5-star, or the S&P 500, excuse me, SPX and SPY would tend to follow the general market. But let's look at something different, okay? And I don't want to use, I'll use the VIX, but we're going to do something different. VIX, of course, is counter market, meaning that if we're expecting a large downturn in the market, the VIX is going to move up. So rather than using that put ratio, which would increase to the downside, I'm going to use a call ratio. Okay? So I want to sell a call. We'll go out again 33 days in this case. I want to sell a call that gives me enough premium, but I can't keep one strike apart. Again, you can see the prices here are a little varied. Let's try 3 strikes. So if I sold this at about $2 and I bought, yeah, I'd have to go to the 17, 4 points apart. Still not good, but let's try the 16s, you know. So let's go ahead and sell the 13s. And we're going to say we got $2 in premium for selling that just out of money 13 call. At the same time, we're going to buy 2 16 strikes. But let's say we only paid 90 cents. Now we're going to get a small, I'm sorry, let's say we collected $1.10. Nope, 90 cents. I was right the first time. All right, so there's a back ratio spread. But again, too much difference in strike prices for the net credit you're getting. See, the max risk is 280 because I've got a $3 difference in strike before the long options cover the short option requirement. So it's still not setting us up to where we want to be. Okay, and Martin makes a comment, let's check the Qs. Okay, so one last example here. Ratio back spread using puts again on the Qs. So 14 days out. No, still have to go about 2 strikes apart or 3 strikes apart. So if I did the 145, I have to go to the 143. That's just about it. That's just break even there. So I'm still 2 strikes apart, not 1. If I sell one here and buy 2, now I'm at 80-cent debit. I'd still have to go 2 strikes apart. And the 146, 257 to the 145 at 2, that's not going to be a credit. Okay, so it's not there using the puts or the calls. Okay, even if which wouldn't be reversed, if I use the inverse, I could get 120 for selling the 145 50s and then paid 140 here. I'm still at a debit. Nothing's giving us a credit. But let's take a look here at 2 strikes apart, even with a small net credit. So I go to 145s, we sell them at 2. Now if I bought 2 144s 1 strike apart, that'd be 230. We'd be at a 30-cent debit. I really want a credit. So let's go ahead and go, she's got to go all the way to the 142s again. Now they're 3 strikes apart with a single strike differences. It's not going to work again. Okay, so we sell 1 and buy 2. And this will give us a decent net credit of $22. So if we're wrong and the markets stay up or neutral, we still might make a profit, but then we still have the dip. Okay. In essence, Martin, where I'm going with this is that I did look at it, but the problem is during this week, I was breaking down if the market fell, as it did when we looked at it the other day, a few points, or the NASDAQ fell a few points, when we were talking about it during that August 10th changeover, when the market fell on August 10th, August 9th to August 10th, I pulled up different ratio spreads with the prices at the time on the broad-based indexes and ETFs and compared it to what Sam and I were talking about with using VIX, using UVXY, using some of the other volatility measures, or just insuring a stock portfolio directly. And on Wednesday, we're going to compare the different numbers from the 2 recent downturns we've seen this year in SPX and in the market. And so that webinar on Wednesday, again, I don't have it created, so I don't have the link for you, but stock or portfolio insurance, we're going to go more in depth to this. But believe it or not, this is what I was seeing most of the time, is that these ratio spreads that you were talking about, closer in or even farther away, were just not in that 1 strike difference we really wanted for it to work. Okay, and if you go 2 strikes now, you're setting it too far apart. So I can do one with 2 strikes here, but I'm still going to be risking $1.90 because I'm only getting a 10-cent net credit. I can't do the 145 to the 144 because that would be a $1.80 cost versus a $1.40 maybe premium coming in. It'd still be at a debit of 40 cents. So the risk would be $1.40. and doing the 144s to the 143s, it's a 30-cent debit. So I'm still risking 130 if the stock's trading right at the 143. I need it to go much lower. Okay, and then if we go the 2 points, we saw it would happen there. I'd still have a risk of 190. So again, we sell here to get the higher premium. We're hoping to buy 2 cheaper ones to get in at a credit. I'm going to cheat and get some good prices here on this one. We're going to sell our higher strike 144. Let's put in 95 cents. We're going to cheat. We're going to buy 2 of the 142s at 40. So we're going to get a 15-cent net credit. But again, the risk is 185. In order for it to work, you're still going to have this dip here. But again, to lessen that dip and what we talked about last week, to get that better lower break even, this is already done at 140.15. So you're looking at a 4-point drop in QQQ in a week before you hit to the profit zone, or it stays where it is. Okay, now that's too tight of a margin to get that done. Okay. Well, someone said, Jim, it looks like, said, what about going further out in time? Do you get better premiums? Not necessarily. You get better premiums, but you don't get better ratios. Let's go all the way out to January. And remember, we're trying to find a low-risk bearish spread, maybe 1 or 2 points apart. But here you see, sure, I can get 569 or 570, but then everything else near it is still 490. In order to get a debit here, or credit, excuse me, let's see, we've got to go down to about the 134s, the 135s even, in order for that to work. So now that's a 10-point spread with only getting a 30-cent net credit. So that dip in the middle, if this index ETF happens to be right at 135, that's the problem. Okay, we looked at the VIX and so forth. One of the things I mentioned to Martin last week was he wants this ratio spread. Okay, he wants this ratio back spread. There's nothing wrong with that if it works. But we were having a lot of trouble last week getting them to work numerically. But rather than setting it up with the structure we were looking at, what if we reversed it and did do it at a debit? But instead, I bought the 145 instead of selling it and sold 2 of the 144s. Now, this doesn't work the way we want it to, but if we flipped it again, okay, that would be, what this is a standard ratio spread. The standard ratio spread, my apologies, of buying one here and selling 2 at the lower strike. That's what we were looking at initially. But what if I did it in this fashion? I'm sorry, Martin was buying twice as many of the lower strike. But if I reverse it, it's not quite what we want, is it? Because now we've got a maximum risk to the downside. Now this break even looks a little bit about the same to 140, but now I've got 2 short puts where I could lose. This is more of a bullish play where if it stays the same or moves down or goes up, you're making a reasonable profit even though you entered it at a debit. Because essentially you're in a bull put credit spread with an extra short put added to lower the cost. Okay, so it's a credit of 172. So the stock moves above both, you keep the 172. This is sort of the kind of ratio spread if you were neutral to bullish. And you still give yourself some protection if it does fall. What he's looking for is a hedge to create a spread, in this case, that has infinite upside to the downside, being bearish. And so we tried, that's what we were trying, buying 2, and selling 1. You don't want to sell 2 and buy 1 because then that gives you the infinite risk to the downside. Okay? So, but this one here is not for what you were looking at, Martin. This is for if you're neutral to bullish. You're trying to hedge your portfolio expecting, from what we talked about last week, a large market downturn. Okay? And in this case, remember, this doesn't stop and go back up as we saw before. What this profit and loss chart will do is continue to lose. So if there is a market correction, we go down to 135, what do you have? Well, you've got now that sort of bullish put credit spread on QQQ, but now you also have a naked put which has infinite risk as it continues to move down. Okay, so that's open risk. So this isn't what you want. But if you're neutral to bullish, this might be a good play. It gives you a wide break even, you can still make a decent profit to the upside and so forth. Now, you could reverse this with calls, but again, it's a capped gain. It's not increasing it to the downside. Okay, so other aspects that you might consider that we were looking for is switching it, doing the ratio you were talking about. It was in October, I'm sorry, 28 days out. But instead of selling the higher and buying the two lower, what if you buy the two higher and sell one lower? Now you do it at a debit. So I'm going to buy two of the higher and pay out about $5, $5.10, and I'm going to sell one of the lowers. So essentially, it's a bear put debit spread with an extra put. Now, this has the risk to the upside higher than what you were trying to look for with your ratio, but remember, my break-even's at 143 instead of being at 140. And as the stock continues to move down, I have an infinite upside. So I'm paying a debit of 302, but then again, if I was really interested in doing this, you could say, why not just buy the one at 259? Buy one contract at 259 at the 145, so then your risk's only 259, or buy one at the 144. Why complicate it with the spread? And doing it in that fashion, because I'm still risking 302. Yes, I've got a decent break even at 143 if it continues down, but if I just bought the 144 at 216, my risk is 216, my break even's 141.84. So not as good, but that's still the range. Okay? But now we talk about the second part of the webinar that we're going to present on Wednesday is how much money would you need if you had a $100,000 account and you wanted to sort of protect against a market downturn by hedging 40, 50, 60% of the potential losses or more. You're going to have to buy a lot of contracts. Okay, so there was a different thing also. Okay, so that's what we're going to talk about on Wednesday. Now, I'm going to get into Randy's question. Randy's got a long question, so just bear with me. Randy says he just started a trial with power options. Well, welcome, Randy. It's great to see you here. And he was curious if you utilize a strategy of buying a long call and covering it with a short call. Yes, there's multiple ways to do it. It's a calendar spread. Whether you want to call it a diagonal spread using different strike prices, or if you're using the same strike called a horizontal spread. They're all still calendar spreads. Okay? And what you say is, I tend to buy the long during the ex-dividend month. So looking for where the ex-dividend is. And then selling a short call for the current week if it offers weeklies. I will then exercise for the option the day before ex-dividend and convert back to a long call 3 months out after ex-dividend. Is this strategy something you do? No. I don't particularly play dividend stocks in this fashion, Randy. I do calendar spreads with maybe about 15 to 20% of my portfolio. I think I'm about 15% of my active portfolio in options is with calendar spreads. But let's take a look at how we might set this up. Now, because next week, Randy, is a standard expiration, we're going to get some results in our search I'm going to show you that you might not like. But that's okay, because it's going to work later on. Why do I say that? Because next week, every optionable stock is expiring. Okay, so all 4,400. The following week after that, only 430 or so of the stocks, indexes, and ETFs that offer weekly options, more along the lines you'll be looking for, show better weekly options. But what I want to do here, Randy, is go into other strategies first. If you don't see calendar call on your available strategy tabs and power options, go to other strategies, and this allows you to customize the view based on what you want to see. So I'm going to go ahead for right now, and I'm going to take out long straddle. Why not? And over here on the left, on the active strategies, we're going to go ahead and add in calendar call. Okay, and click Add to Menu. Now down here I have to go ahead and save that configuration. Calendar calls are now available. All right, so let's go to search. No, calendar call. Let's go to the calendar call home. Of course, this is a strategy of just any combination of buying an option that's further out in time, that's either at or below the short call, and selling a short call weekly, monthly, or shorter term. If they're at the same strike, so we have a stock at 50, if I sell the September 15 50 call and buy the January 50, this would be a horizontal spread, and we'd have sort of an A or a tent frame profit and loss chart. This profit and loss chart is more along the lines if I bought a January, let's say, 45 and sold the September 50 here, okay, or the weekly. But you want to do something unique. And I'm not saying your strategy is a bad one. I'm saying I don't trade it specifically related to dividends. But let's take a look at it and let's maybe kind of analyze the pros and cons. Okay, sorry about that, folks. Just needed a little quick drink of water. 1 second. Let's go into search. And Randy, when you first go into search under calendar call, you're going to see a listing of available trades that match our default criteria. Now let's ignore all the numbers. Let's scroll down below the listed trades to the parameter field. Okay? And this is where you have all the various criteria that you can use to create your personal search. What we're going to do first is over here in the upper right-hand corner. Here we go. I'm going to go ahead and hit clear filters. That's going to empty everything out of our criteria field. And for the time being, we're going to set our near-term expiration in our options section, okay, the options tab. I'm going to set the near-term expiration It's strange. Should have September 15th here. Sorry about that, but that's okay. We're just going to set it to September. Oh, I'm sorry. That is my apologies. It's not September 8th. It's September 8 days away. Sometimes even I get confused when the numbers match up. Standard September expiration, which is considered a weekly. And we're going to go, let's go to December. We'll use standard for right now. Okay, so we've just set the expiration timeframes. If you're not at standard September, you can just select all expirations and go, let's say 2 to 10 days out in time to show you the 1 week next out series. Now, in addition to that, you can set things for the short time value, the percentage short time value of the option you're selling, the time value ratio, implied volatility of the sell or the buy, or the implied volatility ratio. Set your maximum net debit. Now, it's listed as a net credit, so I want to look for a negative debit, but really what I'm going to focus on is I want a max return of at least 4. Yeah, that sounds good. And a downside protection of at least 4 as well. Now, the downside protection here refers to the premium I'm collecting divided by the cost of the leap option. So I want to make sure I'm generating at least 4%. Okay? And then you can set your range in or out of the money. So I'm going to want my short call, let's just say percentage out of the money to be 0 to 3%, no more than that. And my in the money far call, percentage-wise, I want it to be at least maybe 2% to, let's just say 6%, 5%, I should say. Okay? And then you can set other things for the delta, your short option delta, your long option delta, your delta ratio. Look for delta ratio of greater than 1.6 to start. And of course, for me, debit to strike difference ratio is always important. What is this? It's the net debit that I'm paying divided by the difference in the strike prices. I always want this to be less than 1 when I'm doing these kind of spreads. Okay? Why? Because if I am, for whatever reason, assigned early on the short option and my broker uses the long to exercise the short in the first right cycle, what I want to do is make sure that the debit I paid is less than the difference in strike prices. Because if I'm exercised out, my broker has to exercise the long, I just get the difference in the strike prices back. So if I paid a $2 debit, but I only have a $1.50 difference in strike prices, well, that means I'd be guaranteed a 50-cent loss if I'm assigned early. I want that reversed. I want to have a debit of only $1.50 with a strike difference of 2. Okay, so I'm looking for a debit to strike difference ratio of less than 1. At least 10 cents here. And let's put in some liquidity. Now, the trickier part, of course, is let's go into fundamentals, and here you might set other things you'd want to see. You might want stocks that maybe show a good earnings, but you're going to want an ex-dividend date sort of between now and between now and expiration. What I don't have a way for you to do is select it for both. All right, this one I think is just looking at the short option. So let's go not between now and expiration. My apologies. And at the same time, I'm going to set a percent dividend yield. Let's go 2.5%, okay? Minimum. All right, so that's an annual dividend. I'm looking for stocks automatically that pay at least a 2.5% dividend. I don't want it between now and the short expiration. I want it between now, the short, and the long, which is something I can look into for you. And then we could set in other technicals as well. One thing I'm going to do here is, my apologies, one result per security. You don't have to do that. I'm doing it just to limit those. Okay, there's nothing here that matches my criteria. Why? Return's good, that's good, that's good. Delta ratio is good. Option volume and open interest is good. You know what? I apologize. Let's do it this way. Maybe it is looking at both. I have a feeling it's looking at both. No. Okay. I bet you that's it. Let me take these two out. Just real quick, let me just take those two out. There we go. Okay. So, I'm going to clean this up for you very quickly. I made the page a little bit bigger so that we could see the numbers, but right now we're focusing on something a little bit different. I'm going to take most of the values out of this. I put in everything for the implied volatility ratios and more that you can set. I'm going to go ahead and select here, though, Randy, to choose more columns. I'm going to take a lot of stuff out very quickly. That I want, that I want, that I want. Debit I want. Break even don't need, delta ratio don't need, for our example. I'll take all the implied volatilities and deltas out for now. So you can add in a lot of other information here. Okay. And for the stock itself, I want the company name. Volatility we don't need. Stock symbol last strike. And what we need to know now, well, you can put in the dividend yield, but what you really need to know is the ex-dividend date. I want to add that to my column specifically for your strategy. Okay, let's go ahead and submit and save that. Close the window. All right, so we've got a lot of them. A lot of them have come out recently, but haven't released their next ex-dividend. This XLU one is interesting. The spider, oh, maybe it only pays every 180 days instead. And this BUD is passed at 130. They haven't released a new one. Anheuser-Busch, they might have canceled their dividend. There's only 16 results. Let me go back here. Yeah, trying to look for ones. They should have, some other ones should be appearing soon. I mean, this one's going to have, GE is going to have dividends. It's got to have a dividend sometime within the next 6 days. Let's take a look here on it. It's showing me that it last paid 84 days ago. Last ex-dividend was 616. It was 24 cents. So the other one should be coming up on September 16th. That's interesting. I got to make sure that's coming up correctly. I don't think GE canceled their dividend, but this is one where you're doing it a little bit different. You're selling September 15th. The dividend's going to be in the 15th, the 18th. But you want the dividend more in this range, which a lot of them would be. You know, those ones that just paid 1 or 2 days ago, 9 days ago, 7 days ago, you're going to be in that range where they're going to be paying sometime around December in the next 90 days, 3 months away. So those are going to be some targets you might want to look for. And these ones here, Pfizer, for example, paid 37 days ago, so maybe by November you could pay it, so there might be a combination there. Now, let me take a look at Pfizer real quick. Yeah, last ex-dividend was 8.2. It was 36 days ago. They haven't released where their next one is. We can assume it's around 11.2. So what does that tell me? Let me show you something else. What I just walked through was how I would structure a search looking for calendar spreads with some basic criteria on dividend-paying stocks, and then I could change the sort by last dividend date or most recent, change it to dividend date or ex-dividend date from highest to lowest or lowest to highest. So you could sort those how you wanted to. Then you could open up the results more. So a lot of these, you're selling the short term at the money, but you're not getting a lot of premium. I had to take that out. You see why only a few of them had 10-cent premiums. But you're buying it deeper in the money. But now let's take Pfizer here. We saw that its dividend came out on 8.2. So we can assume that November 2nd is going to be its next dividend. Now let's say I want to look individually at PFE, knowing when its dividend is. So I want to look for positions where I'm selling the weekly or 1 week out, and I'm buying November just after, expiration just after. Well, so what I can do now is I'm going to go back here. We're going to leave this information in the fundamentals for the moment. I'm going to change my expiration to November if it's available. No guarantee that Pfizer has a November series. And I'm going to leave all my other criteria but take out the one result per security I used to save time so we didn't see multiple duplicates. Now I want to see duplicates, but just on Pfizer. So let's go back to the fundamentals, and I'm going to search specifically by PFE. All right. So with my criteria, there's only one with a stock at 34.10. So let's take out one more thing. I'm going to take out this out of the money restriction on the short call. I'm going to allow it to go to the 34 or the 35. And I'm going to put this 0 to 6 so I can see the 34 call as well. Let's open it up a little bit more. There we go. Still selling the 35s and the 33s, okay? I can go slightly in the money, so I have to, I don't think I need to allow that, but let's go ahead and allow it. So no more than 2 in, no more than 3 out. Should be giving me the 34s, unless we're not seeing a 4% return, which I think is impossible. I still think we'd get some return. There's got to be volume, well, there's got to be open interest, so let's just take a look here. Oh, no wonder. I'm sorry. I really apologize. My delta ratio is going to be nowhere near 1.6 if I'm doing that. Let's try to keep it greater than 1, however. Wow. It's trying to get the 34 short in there, and it's not having it. But, here's the 34 and the 33 combination. So assuming that the dividend is going to be around November 2nd, as the last one was paid on August 2nd, here's your November series. Let's take a look. This one's giving me about a 29.4% max return, and the closer strikes 34 to 35. Let's use the 33 though, but I'm going to change it. I'm actually going to use, that's what your calendar spread would look like with your November put, with dividends hopefully coming around November 2nd. But I'm going to change the numbers here. We're going to use that 33 November call, but naturally I want to get more premium here. I want next week out 34 call, even though it's about 10 cents in the money. I want to get 31 cents, so we're still getting about 20 cents. Now this gives us 2 ways to lose. Return is still relatively decent, but monetarily it's not a good number. But again, your plan here now is to, as the stock gets to ex-dividend, you're going to exercise this one early to be on record. So on November 1st or the 29th of October, you're going to exercise the stock. Okay? So let's say that on the 29th of October, we're still around 34.10. You end up buying 100 shares of Pfizer at 33. But in reality, since you exercise this, this goes away. Your original debit was 127, so remember, now it gets tricky. You're still buying this at 34.27. You've got to add the debit you paid in to account for that. Okay? So now we've got 100 at 34.27. We sell the 31 strike. Now you might get 29 cents. in this example, I don't think this is a good position. I'm not saying you would do this, Roy. I don't think this is a good position. It depends on where the stock is at the time, and it depends on the structure. Now, I had to use the 34 strike to get a reasonable premium 1 week out. You could go 2 weeks out. The 15th, for example, I'm sorry, the 22nd, 34.50 at 16 to 19 cents and 4 to 7 cents there. Of course, it's Pfizer. It's lower volatility, so you're not getting as much premium, and everyone knows the dividend's coming up in November. But again, to answer your question, add calendar call, go into the search, clear the settings, set your expiration to the near-term weekly. I recommend going all expirations 2 to 10 days. And at first, I just leave this open. Maybe go to January, or go a wide range when you're first creating your search. I can go all expirations, and I can go 85 to 95 days out, or let's say 115 days out. Okay. And then, of course, we want to set your maximum return requirement. Range out of the money for the option you're selling, what's called the near call, the option you're selling, and the range in the money for the far call. You don't have to set a delta ratio. I did it because that's how I prefer, and I prefer my debit to strike difference ratios doing any calendar spread. You can just set a basic open interest to greater than 0. And you go back into fundamentals now, put in a dividend yield, 2.5%, whatever you're looking for, and just run the search and see what you get. Now, this is going to come up with a lot more trades. Cracker Barrel, because I selected a wider expiration time frame, and I didn't limit it to 1 result per security. Okay? But then again, what did I also do? I also went into choose columns to see when the last dividends were. So again, CBRL, Cracker Barrel's last dividend was on 7/12. So the next one's coming in October. Well, this showed me a December series. I can change it now and look for the October series, assuming it's going to be paid again around 10/12. I can look at the October series now against the September weeklies and see how that works. A quick way to do that, of course, is just what we showed. We could go to stocks at 144.72. Let's do the 145s. Okay, so let's again go to the profit and loss chart. I have a sentiment feeling this is going to be coming out before October expiration. Let's clear out the December. Let's go with the 140. Let's keep it closer. Call this a cost of 750. Why is the 145 at 345? That's amazing. That seems really high. I guess they might have earnings coming up. Okay, so now here's an interesting spread with a September 145 at 345, and we're planning on the October series. The dividend, I'm sorry, coming out before October 20th, probably around October 2nd. But this is a good-looking calendar here, a debit of 405, theoretical return of 329. I bet you the volatilities are inflated. Yeah, they're pretty high for this stock. What does that tell me? It tells me sometimes either before September expiration or just between September and October, but really before September expiration. Yeah. Cracker Barrel is going to have earnings on 9/13 before the market opens. So what does that mean? That means that if earnings disappoint, the stock could drop 10 or 12%, $14 down to $130. Not what we're looking for here. Not we might want to go deeper in the money to get better protection. But again, even though your play is this dividend play, and this looks like the proper structure that we'd want, I'm not sure if I want to trade a position that has earnings between now and the short option expiration. Okay, so let's go back. And again, as we saw, it's one thing you can change. Go to fundamentals. Earnings date not between now and expiration. Get out Cracker Barrel and a few others. Back to Pfizer, Wells Fargo, Cummins Engine. It's one out to December again. And then check your dividend dates there as well. Okay? All right. And of course, Roy, excuse me, if you have any questions about that, remember you can send me an email at any time. You can call the market during office hours Monday through Friday, or you can schedule a coaching session. And if you're going to talk, if you schedule a coaching sessions and it's at a time where I'm not available and you get Ernie, he'll most likely try to find a way to make sure I'm available if you want to discuss calendar spreads. Ernie doesn't, I've played with calendar spreads and traded calendar spreads more than Ernie has, so he usually tries to defer all calendar, diagonal, and horizontal questions to me if he can, okay, if it's available. All right. So moving on from our calendar spread search discussion for this particular strategy for what Roy was looking for, we're going to take a little step now towards Rajiv. And he wants to know about management. Okay, so he says he bought XOM, ExxonMobil, September 22nd, 78 call, and sold a September 15 call next week at 785. Now, both in the money from the initial trade price, which might be okay. You say minus 19, now it's 55. What is the best strategy to close out this kind of trade? All right, calendar spread management, XOM. September 22nd. Now, you say that, I guess you paid a debit of 19 and it's going to cost you 55, or did you leg into this, Rajiv, and received a net credit of 19 cents? And now it's 55 to close. But let's take a look here. This is September 78 call right now. September 22nd, we'll call it 127. Okay? I'm going to buy, well, right now the current prices are at 127. And the September 15, next week's expiration, 78.50. Debit of 72. Okay, oh, sorry folks. All right, so right there, ladies and gentlemen, now this is what if I would be if I was entering it right now. But you can see Rajiv's dilemma. It's going to cost him, okay, so what he could do now, actually this isn't that bad at all. You said you paid a 19-cent debit, okay? So for this originally, let's say that you collected, you paid 127. That's not true. It was probably at a different price. So let's say you paid 89 cents for this, and you collected 70 cents for this, for a debit of 19 cents 1 week out in time. Okay? All right. So your question is, what would you look to manage this position? I think you're profitable if you close it. Right? It's going to cost you, when you took in 19, yeah, you're going to get 55 cents back. Okay? So, okay, you said 11 and 30. Okay, well, that's fine. Let's just change the numbers. This was 30 at the time. This was 11. Okay? So this is what your position looks like now. You're in the profit zone. All right? If you're worried about managing it or getting assigned, just liquidate it. All right? Because remember, what's going to happen here? Well, you sold to open the 78.50, so you're going to buy to close it at 72 cents. Okay, so I'm going to buy one at 72 cents. Now, this isn't a spread. I'm just showing this as an example. That looks like a debit of 91. But remember, you've bought the 78 call. So your action to liquidate would be to sell to close this, and we set at a price of 127. Now, this is going to give me a straight profit and loss chart, but guess what? That's your profit. Okay, you've got a profit of $36 on a 19-cent investment, or 257%. You said, can you move up to the September 78.50? Yeah. I mean, let's take a look at it, okay? I don't mean to sound condescending. What I'm showing you is you've got a profit of 36 cents at liquidating right now off of a 19-cent debit. Okay, you're almost at, 300% gain here. Okay, it's pretty close. But okay, if you want more, if you want to see what rolling would do, you're going to end up creating a bull call debit spread. All right. So what would we have to do? We have to buy to close the 78.50. 72 cents once again. I already had that in there. I'm sorry. I shouldn't have gone through that extra step. But to roll it now, buying to close the 78.50, and if I open the September 22nd 78.50 at 93 cents, let's say, now essentially, I'm going to do this a different way. Actually, hold on one second. I'm going to do this a different way. You originally collected 11 and you had to pay back 72. So you're adding 61 cents, aren't you? Right, into the position. We sold the 78.50 for 11. I have to buy the 78.50 for 72 cents. So I'm a debit of 62 cents. Here's why I don't like that. What that would do is change this to 92 cents. Yeah, I still paid 30 cents for the call. I'm adding 62 cents in to buy to close the short. So I now have a 78 call at 92 cents, a 78.50 call at 93. Bull call debit spread, and the maximum profit is 51. Okay, but now what's different? I got to put up a little monetary requirement here. Oh, I'm sorry, no you don't. No you don't. You're fine there. Okay. So what's interesting now is that you can't lose any money if it continues down, but if it moves up, yeah, if it stays above 78.50, it's going to give you, it threw it off here because it's done at a credit. It's reading it differently and it's done at a credit. But this number is correct. The maximum profit would now be 51, as opposed to what we were just looking at. Let me go back to, with a profit of 36. All right, so even adding the debit and rolling out a little bit more for another 90 cents will give you another 15 cents of positive premium. Potential max return, if and only if the stock's above 78.50 in the next week. Or you could liquidate now or on Monday and get the $36 back off of the 19-cent investment and have the 257% return. Okay. Sure, you could increase it. You're absolutely right. You can increase it by 15 cents to a max profit of 51 cents by rolling it to that September 78.50 strike. The math would work out to get 15 cents extra. But then the stock would have to be above 78.50 next week to get the maximum return. If it falls below 78, what did we see? Well, you're still going to have a profit of 1 cent. Here it is. Right? You sort of got a bulletproof bull call debit spread. So you're still guaranteed to make 1 cent on the position even if both options expire worthless in that scenario. But again, you could make 51 cents maximum profit if the stock's above 78.50 as opposed to the 36 cents you have right now. Okay. Why am I not going into any deeper management? Because you're so close to right at the money and you're so close to the expiration of the long option that really if you want to roll out the short, you can only roll out to next week. Not next week, being the 15th, but the following week, the 22nd. You don't have any more choices. Could you roll the whole spread out? Yeah, but now you're playing a whole different timing game on the position. You'd have to reevaluate your strikes. If you don't want to risk assignment, you're not happy with the 257% return, and you want to go for that sort of 51 extra 15 cents, absolutely. You could roll up here. Remember, that's going to adjust the cost basis of your long. You originally paid 30 cents for it, but it's going to cost you 72 cents to buy to close the 78.50 call for next week, which you got at 11. So that adds 61 cents here. So the new cost, actually, I'm sorry, the new cost here would be about 91 cents. And you could sell to open the 22nd of September 78.50 call for 93. You're in a debit spread at a credit because of the adjustment, and you could make 15 cents more than what you have right now. Okay? And you said you have similar positions on Walmart and SLV. Now, if you have more weeks to expiration on the Walmart or SLV strategy, Rajiv, if these are out to, say, October 2nd, I don't know if that's even real. October 6th, that's the real one, or October 13th, you probably have other management you could do. But if both that Walmart and SLV position are out to September 22nd, yeah, you just have to decide next week based on where the prices are. Do you want to roll it out 1 week to make it a vertical spread, and how would that affect the position based on your buyback cost of the short option and the new premium, or liquidate now and take the profit? I don't know what's going to happen next week. I'm not going to even speculate on if anyone's going to say something silly or the impact, of course, that different storms might have, and And consider what's going on in Houston, what just happened in the Caribbean and Barbuda and Antigua and everything, and then you think about Mexico for a second, gets hit with an 8.1% earthquake, and then they've got Katia knocking at the coastal door there on the other side. It's just, we don't know what's going to happen in Florida over the weekend. We don't know the extent of the devastation. We, of course, all hope it's small. We don't know what effect that's going to have on the market. You're in calendar calls, okay? Volatility effect or the market falling, is it worth it to stay an extra 7 days in on this position we're talking about to try to get the extra 15 cents when, yes, it's above both strike prices now, but if it falls, if it goes below 78, well, your position that you have right now that's at a profit that you had could actually become a loss next week. So that's the debate. We don't know what's going forward. We know there are certain things we can't control. Hey, let's not forget about wildfires out in the Pacific Northwest either. Lots of things going on, and was just added to last night with the earthquake there. So that's natural disaster, something to consider, the effect on the markets. And market didn't really do too bad today. NASDAQ got hit harder towards the end of the day, I saw. It looked like they were both about up a little, down a little, not moving too much, SPX and NDX, and then NASDAQ's down almost 1% at the end of the day. So something to consider there, something to always be worried about. Management is a great idea. That management would improve your position. I agree with that, but it's dependent on the stock staying above 78.50, okay? Oh, well, you've got, I'm sorry, last one here is from Rajiv, is he also had a naked put on Disney around earnings, okay? And when the DIS position he had, looks like he has a September standard expiration. Oops, didn't want to go there. Let's go to custom spreads, I'm sorry. And let's go to DIS. Just take a look at a short put here. September standard, 100 put. I don't know, maybe you collected 80 cents for it, okay? All right. Okay, so, well, it's 0.8% yield. Let's increase that. I'm going to take it up to 140. Let's give ourselves a little bit better premium, 1.4%. In any case, let's say we got this at 80. Okay, it's right around 80. Okay, so I was right the first time. Let me just go back to it. Really, it's not, in my opinion, it's not a big deal, but it depends on what you have in your capital, okay? So down to 97.07, you collected 80 cents. Your break-even's 99.20, which is just 2 points below this position. Oh, okay, $2.20. All right, that's not a bad loss to take. So your choices are, 1, buy to close the put, just get out of the position, okay? 1, BTC, close the put, take a loss. You know, you might pay about $3 or so to buy to close this position, $2.95. Okay, it'd be closer to $3.10, but you keep 80, so you're only losing $2.30. That's not 2% off the monetary investment of 100. That's not too bad. Number 2, do you think the earnings was an overreaction and Disney is strong and is going to recover? Well, depending on how it goes next week, what can you do? Take assignment. You'll now own 100 shares of Disney at $99.20. Okay, so take assignment. You own 100 shares at $99.20. The stock, of course, I know, is at 97-ish. So what could you do? Well, maybe you could sell a 98 strike. Call a couple weeks out. Get another 60, 70 cents of premium. Knock your cost basis down to 98.60. Stock still trading at 97 or 97.50. Sell another 98 call for the next 2 weeks out if that expires. Convert it to a covered call position. Essentially it. Maybe a collar if you're worried about it still falling. Number 3, hey, you want to stay in the put, just roll the put. Buy to close this, take a 230 loss, maybe sell to open in October 97.50 or something along those lines. Get maybe, let's take a look, maybe $1.10, $1.20 back. So just rolling the put itself. Let's go to standard. I know you probably don't go out this far based on what I saw in your calendar spreads. Well, the 95 is at 140. Okay, I thought it, sorry, it's, yeah, it's below 97.50, so you might not want to sell that. The 95 is at 140. Okay, we could go shorter term. Remember, we're going to be at a loss at about 230. buying to close the put or whatever. So let's go to October 6th, 28 days out. The 97 strikes at about 170, so it's more than half. Or and play it safe and go to the 96 at about 130. So again, that's half. Take off half of that. 28 days from now, that expires. If it's above 97, write another one. Okay. Another thing that you could do, something that we have that we offer that you might have seen before, Rajiv, is the stock repair tool. Okay, so let's say that I decide next week, you can't decide, but let's say it's September, you take assignment, and the stock's still trading at around $97 per share. One thing you could do is go over to the stock repair tool, plan on taking assignment. What do I know my cost basis is? $99.20, because I kept the 80 cents from the short put, got assigned at 100, I have 100 shares. See if a ratio call spread to help you get back to break even faster is available. Break even here at 97.98. It's showing you repair details for a ratio call spread. There's ratio repairs available to October. You know, probably going to need it to go up to 97 or so, $98, but it's not back to 99.20. Okay, it's a stock repair. You're going to sell 2 calls and buy 1, get a small net credit, and essentially you've got a bull call debit spread with an extra short call done at a credit for you. That's another way that you could do it. So close it, take the loss. Take assignment on the stock, convert it to a covered call. Roll the naked put by itself, accept assignment, look at the ratio repair, the stock repair tool to find better position. If you want more ideas, go to our webinars page as always. And of course, you know, this is where some of our other discussions you can find here. It's a public page. Just go to poweropt.com/webinars.asp. And what you want to do, Rajiv, when you go to that page, I just sent it to everyone in the chat window there, go under Option Strategies. And here we have a lot of our archive webinars. For Roy, we discuss here the calendar spread basics, which you're a little bit beyond because you're doing a specific calendar spread screen. But the calendar spread criteria are discussing the criteria we like to use for our calendar spreads, but it'll show you using the Power Options tools to help you get more familiar with setting up the different structures for calendar spreads. Further down, you've got webinars on management of certain strategies, straddles and strangles. But what you're going to want, Rajiv, is managing your naked put positions. Okay, so we talk about management techniques and adjustments for naked put positions to help maximize gains or minimize losses. Whether the naked put performed as you wanted, dropped just below your short put strike, or dropped significantly, we show various ways to turn a loser into a winner or maximize the profits on a winning trade. So regarding Disney, yeah, you've got multiple choices there, but it does depend on what your expectations are for the stock going forward. Could you convert it to a weird ratio spread like we were looking at with Martin earlier? A ratio back spread? Could you buy 2 97 strike or 98 strike options or 97 strike options for next week if the stock continues to move down to have that infinite profit to the downside? Sure, but why complicate it? Because if you do the ratio back spread and the stock recovers, what would have been a winner might actually be a loss. Okay, so the adjustment has to depend on what your expectations are. The stock's down below 100 after earnings, but do you feel it's an overreaction? Do you feel the stock might be closer and move back up to 98 or 99 by the end of next week, and it might only cost you $1 or 50 cents to buy back that option that you sold? If the stock goes back up to around 99.50 and it only costs you 50 cents to buy to close that put, you still got a 30-cent profit. Not the full profit you expected. But again, elaborate management techniques of trying to convert a naked put into some kind of ratio spread, broken wing butterfly, or even a simple vertical spread can work, but they usually only work if you still have 10, 15, 20 days to expiration and suddenly went against you. When you're this close to 5 days left to expiration, it's going to be a little bit harder to convert to a spread, and you can complicate matters by converting it to some kind of ratio or elaborate spread to repair that naked put with such a short time left, only 5 days left to expiration. If the stock recovers, what would have been a winner could now be a loser, and it could be significant, more than what you're losing right now, depending on how you try to repair the position. Okay, so first, reassess the stock itself. And you might need a full trading day next week, the first trading day Monday of next week, to say, well, is it coming back now? Is it recovering? What does the market look like? Did or did not anything happen over the weekend that was more devastating than anticipated, and the market's pulling back because of it, which will affect everything? Check out that webinar to show you different ideas of management. But again, for the short term, you have 5 days left. You could close it and take the loss, especially if you feel there's going to be a decline. It's going to continue to move down over the next 5 days. You just want to close it now. You don't want to try a wild repair. It'd be better just to get out of the position. Okay. 2, if you think Disney's going to recover, you could just take assignment, convert it to a covered call, use some out-of-the-money covered calls to lower your cost basis. Then it moves back up. You might be a winner. That might be a longer-term position, of course, longer-term trading plan, but it's also an option. You could simply just roll down the put instead of taking assignment and converting it to a covered call. Roll down out to maybe October 6th or September 29th expiration. Roll a couple of weeks out, 14 days out, 21 days out. Help repair it with some more premium. You could use elaborate adjustments, or you could wait to take assignment if you think the stock's going to be stable around this 97, 98 range, then see what's available in that ratio repair tool to help you get back to break even faster than typically just rolling the option or converting it. But take a look at the webinar there. It's down here. It's from the 2015, Managing Your Naked Put Positions, February 4th, 2015, but it's pretty much the same exact webinar I teach today if I was teaching a webinar on naked put management, aside from the overview that we just did. All right, well, ladies and gentlemen, that does look like the last question that came in, and we are just after 5:30 p.m. Eastern Time. If you have any last-minute questions, feel free to go ahead and send those in. But I just want to remind everyone, if you haven't done so yet, remember, those of you that are still here online, if you haven't taken advantage of the 14-day trial to Power Options, simply go to poweropt.com, put in your first name, last name, and email address, and then you'll be able to start your 14-day free trial. Full access to all the tools we showed today, plus many more we didn't showcase today. You'll have full use of the 14-day free trial as well. Remember, those of you that are on a trial or subscribers to Power Options, you can schedule one of those coaching sessions at any time. After the trial, we do offer different ranges of subscription. The lowest cost, simplest one is the end-of-day service. You get access to all the search tools for 23 strategies. You get email support. You have access to the portfolio tools, search by symbol tools, other things we showed today, including the stock repair and our signature tools. But it's with end-of-day data. It's only updated at the end of the day. And that's only $40 per month. Now, a 20-minute delayed service gives you a few extra perks, and you get 20-minute delayed data. So the data is updated every 15 to 20 minutes throughout the day. And that is only $60 per month with a discounted annual subscription at $660. So essentially you're getting 1 month free. You can upgrade from the 20-minute delayed to what's called the historical. This gives you access to our backtesting tools, where you can run historical searches in any of the 23 strategies we support using the criteria in the same platform as the search we saw today for the calendar spreads or any other strategy. And our historical data goes back to April of 2006. You can also look at historical options, chains, and more. And that's only $100 per month to have the backtesting application on top of the 20-minute delayed. We, of course, do offer a real-time service. Every time you submit the page or refresh the data, you're getting the numbers and calculations at that very instant. That's $120 per month. And the full package of everything goes up to $160 per month, again, with discounts available for annual subscriptions. With the exception of the end of day. There's no discount for the annual subscription at the end of day service. But if you're interested in another free education, remember, you can always go to our blog, blog.poweropt.com. Of course, you can check out our webinars page. There's 4 categories there. Webinars on the Power Options tools and how to use them. That's the first category, Power Options tools. The option strategies, we saw some of those. There's a variety of webinars on spread trades, introduction to naked puts and covered calls, and then managing naked puts, covered calls, buying options, what we look for criteria, and how to manage long options or short or long calls or long puts that have moved against you or gone in your direction. How to manage those to maximize profits, of course. There's discussion on the criteria and calendar spreads and so forth, many more. There's a basic section for options concepts. We discuss things such as the volatility, the Greeks, special dividends, and more. And then the 4th category that was on the webinars page is the requested topics, where our Friday discussions are posted. Today's discussion will be posted maybe Sunday afternoon or Monday morning, and we'll send out an email to everyone when this is available. Of course, you can always go to our YouTube channel under Power Options to see some of our archived webinars available as well. And of course, if you have direct questions, remember, send me an email at any time. You can send me an email, send us an email, myself, Ernie, Greg, or the other staff members, to support@powerop.com. Or if you have questions about the limited risk radioactive trading techniques, you can send those to any time to support@radioactivetrading.com. Remember, of course, you can also call us during market hours at 302-992-7971. We're usually here from 9 a.m. to 6 p.m. Monday through Friday, so you can give us a call anytime as well. All right, and then of course, our trial members and subscribers, you can schedule a coaching session at any time also. So just go into that free coaching link and schedule a session which matches your convenience. And essentially the free coaching session is a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have.